Finding good supply and demand zones is tough, like really tough. Sure, there are things you can do to make it easier, looking for a long preceding move or seeing if a zone has confluence with other factors being the two best methods, but even with those, finding powerful zones is far from easy, especially if you're new to supply and demand trading. Luckily, I've found a tool that makes finding strong zones a lot easier. It's called the COT graph. Using data from the Commitment of Traders report, the COT graph reveals when the banks have increased or decreased their number of open trades in the market, both long and short. In short, we can see when the banks are placing more trades. By combining that with what I explain in my supply and demand book, we can use the data to figure out where the most powerful supply and demand zones lie, making it much easier to find and trade the strongest zones. Sound good? Locating strong zones using the graph is easy enough, but there are a few steps to take to ensure you find the right zones and not the wrong ones. More on this later. First, let me explain why the COT graph is so good for finding powerful zones. Good supply and demand zones are a dime a dozen, and finding the best zones usually requires deep technical knowledge acquired over many years of trading, or at least it did. Enter the COT report. Released every Friday, the Commitment of Traders report, COT, details the positioning of traders in the futures, spot forex and commodities markets, and yes, that includes the banks. The report reveals whether there's been an increase or decrease in net longs, buy trades, or net shorts, sell trades entered into the market. That means you can see whether the banks are entering or removing long or short trades and in what amount. Amazing, right? By understanding how the banks trade and using a little bit of math, you can use this information to determine where the most powerful supply and demand zones lie. For example, this zone has a very high probability of causing a reversal. How do I know? Because during the week it formed, there was a massive increase in the number of sell trades placed by the banks. This is clear if we check the COT graph. By comparing the week the zone formed with the prior week, we can see that between the 24th and 27th of March, the banks entered 24,000 new sell trades, a huge increase. These new trades had to get placed somewhere, but where? Well, since the banks can only sell when price is rising, as they need buyers to sell to, they must have been entered when price was rising during the week the zone developed. And given that the only time price really increased was right before the zone formed, that makes the zone the most likely point they entered these new trades. And as we can see, price soon reversed upon its return, confirming the banks entered their trades here. This is the power of using the COT graph. It makes finding strong zones a breeze. Now, let me show you how to do this yourself. You don't need to be a genius to find institutional zones with the COT graph. I'm evidence of that. But you must go through the correct steps in the right order so you actually locate the good zones and not the weak ones. This is where I come in. To help you along, I've created a simple 3-step method for finding institutional zones using the COT graph. These 3 steps make it easy to take the data from the graph and use it to find the right zones. No experience necessary. Just follow the steps, get the data and locate the institutional zones. Easy. Here's what you need to do. First off, locate the zone you want to check using the COT graph. With this method, we don't find new zones per se, but rather check existing zones against the graph to see which form from the largest number of trades being placed. We'll look at this zone since it's recent and looks kinda nice. Now we've got our zone, we need to find when it formed on a COT graph and see if there was an increase in the number of net shorts for supply zones or net longs for demand zones during that time. So let's do that. In this case, our zone formed between the 21st and 25th of January. Since the COT graph only updates each week, we need to find the figures for those weeks and check if the longs and shorts increased or decreased. Only zones with an increase are powerful. You do this by comparing the number given the week the zone formed with the previous week's numbers. Ideally, we're looking for a big increase, a significant jump higher. A slight increase is important, those trades must be placed somewhere, remember, but a big increase is really what we're looking for. It reveals the banks entered a large number of new trades, telling us whatever zone formed as a result must be pretty powerful. Our zone formed on the 21st of January, which means we need to compare the figures for that week, the COT released every Friday, with the figures of the previous week. The difference will tell us the size of the increase or decrease, giving us an idea of the zone's power. For the week the zone formed, the graph tells us there were 239,515 sell trades open in the market from the banks. Comparing that to the week before, when only 215,235 were open, reveals a difference of 24,280 sell trades, a significant increase week over week. With that in mind, we know the banks A, placed more sell trades during the week the zone formed, and B, want price to continue lower. Why else would they sell? The question now is, where did they place most of these sell trades? While the supply zone is the obvious candidate, we can't just assume they were all placed at the zone. It's too simple. We need to check what else happened during the week, see if any other more suitable zones formed. Let's take a look. If we look at the week we saw the increase marked between the two red lines, we can see there was lots of bearish price action but not much bullish price action, which is what you'd expect in a falling market. Our zone is located near the beginning of the week, but look what happened. Another small supply zone formed. This isn't a great zone by any means, but it has formed from the banks placing some of those 24,000 new sell trades, as did the small swing highs that formed between the 24th and 26th. They could only form if price moved lower, which meant the banks sold here too. Remember, the banks can only sell when price is rising and buy when it's falling. It's a common trap to think bearish price action equals bank selling. It doesn't. The selling comes mostly from retail traders selling and closing losing buy trades. So how do we know where the banks place most of these new sell trades? Well, you use what I explained in my supply and demand guide. You look at the move before the zones formed and compare them against one another. Which had the longer preceding move, our supply zone or the smaller zone that formed later that week? Same goes for the swing highs. What was their preceding move like, small or long? The length of the preceding move reveals how many retail traders were buying before the zone formed, and therefore what size sell trades the banks could place, revealing the power of the zone. With its small retracement, our supply zone is the clear victor here. Compared to some zones we see, its move is tiny, nothing to shout home about. During this small segment of price action, however, it's the only time price was really rising. The other zone formed after a tiny retracement, something that rarely causes many traders to buy. The swing highs all developed from a tiny rise too, ruling them out. So it's clear, most of the bank's 24,000 new sell trades were placed at our supply zone. We can say with confidence this is an institutional zone. We know it developed from the banks placing a significant number of sell trades into the market. Here's how it played out. Once price returned a few days later, a large reversal ensued. See the power now? While finding strong supply and demand zones will never be a walk in the park, the COT graph will give you a major leg up and make the process a whole lot easier. Try it out yourself for a while and you'll see what I mean.